Hello and welcome. In this month's on-demand webinar, OJM Wealth Advisor Andrew Taylor provides a back-to-school briefing on options for funding the rapidly increasing cost of college education. He presents data confirming the economic value of a college degree and includes common mistakes to avoid. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. We'll discuss how you can get a free ebook download or a hard copy of Wealth Management Made Simple, or any of our other books.
Thank you for tuning in today. This afternoon's webinar, Education Funding Essentials, a back-to-school briefing. So our agenda, we're going to share some facts about higher education. We're going to discuss some options for funding college. We'll just discuss common mistakes made by those when funding education costs, and we're going to discuss some steps to take action. Now, we do have a limited amount of time today, so while it may not be possible to cover every element of college planning, I'm going to focus on these broad topics. You can contact us for more detail. The recording today can benefit not only expecting parents with a high school senior, or grandparents, or even those interested in supporting a niece or nephew's education funding efforts. So higher education, what does the data tell us? One of the common questions that you see today, and I often get asked as a financial advisor, is college worth the cost? Now, the answer to this question is obvious for gifted students. However, it is a very fair question for many, given the increasing cost of tuition, the fact that there's a serious labor shortage today, and now suddenly certain trades are offering six-figure salaries because of that labor shortage. So I'm going to provide some data to help answer the question related to the value of education. Simple question: what will I pay? What can I expect my out-of-pocket cost to be? And then we're going to spend some time addressing the type of degree. Does that make a difference? As the price tag continues to escalate, the degree type and the quality of the school become of greater importance when you're performing a return on investment analysis, if you will, as it relates to the cost of education. So tuition inflation, the cost of college has increased dramatically, much more than the broad level of inflation nationally for a variety of services. So what we're seeing here is the average annual increase has run about 6.4%, as it relates to the increase in tuition. And the cost of college, and this is from 1983 to 2017, has increased 776% versus, the cost of housing has increased 161%, medical care, almost 400% over that time frame, but 776% increase in the cost of tuition. Now, why is this occurring? Colleges are having to spend more to attract the best students. So it's becoming very, very competitive to target, the prospective students that they're looking to have enroll in their school. Colleges are also receiving less financial support from states, so therefore, those costs are actually being passed on to the students. What are costs today? What can you expect? The averages for public in-state universities, now again, this is tuition only, is running about $9,700 according to data from J.P. Morgan for the 2018-2019 school year. Public out-of-state, $21,600. Private universities and colleges, $35,700. You need some examples. Harvard, Vanderbilt, Stanford, they ran about $50,000, in tuition for the calendar year. So your all-in cost attending these schools, once you factor room and board and other miscellaneous expenses, could be pushing 70,000 for those schools. Certainly a large number. The public in-state, which again had tuition of around 10,000, you're seeing an all-in cost, running 21 to 27,000 is not, would not be surprising or too far off base. Now, again, you'll notice we have referenced J.P. Morgan's charts here. They've done a great job with data aggregation. So we have again utilized them as a resource for some of the numbers that I'm going to be quoting here. So higher education, is it worth it? Well, it does absolutely pay. So bachelor degree, the holders earn about $1.5 million more over a lifetime versus high school graduates. This information's not surprising to most. Those with a professional degree, tend to earn $3.7 million more over their working lifetime. And on an annual basis, what are the averages? 67,763 for a bachelor's degree versus 38,145 for a high school graduate. Professional degrees, average starting salary tends to be about 98,000. And again, keep in mind these are the averages. Those numbers vary greatly by by degree and university as well. Another key factor in the decision to attend college, and when you ask yourself, is it worth it? It goes beyond income. It's also job security. Take a look at the unemployment rate here of college grads versus high school degree only, no college, and then less than a high school diploma. So the one trend that you'll see consistently is the unemployment rate amongst college grads is drastically lower. Today, that unemployment rate's about 2%, about half of the national rate. But even during difficult times, during financial recessions that we've experienced, it's very, very rare that number exceeds 4%, that number being the unemployment rate. So with escalating costs, you do want a college or university to justify their price tag. It's very reasonable to ask a college or university about their job placement programs and about the starting salaries for both their graduates and the graduates within a specific college or with a specific degree. You can see by the data in front of you here, computer science majors and engineering majors tend to have the highest average starting salary, whereas humanities, social sciences, and education tend to be on the lower end of the scale. So the key takeaway here, what I would tell you is you really want to evaluate the cost of the university versus the starting salary that your child, your student, prospective student, is going to be able to walk away with a kind of offer they can expect when you're determining, hey, what college should I go to? How much should I be willing to spend? Those factors are very, very important and often overlooked. So funding college, the reason many of you attended today, what are listening today or tuning in, what are your options? Well, the most obvious is cash flow. Now, the reality is very few can afford to just pay as you go. It is also the most expensive solution, and I'm going to show you some data on the next slide, which will illustrate the actual true cost of this decision. Another option, loans, grants, and scholarships. We're going to get into EFC, expected family contribution, just at a high level. How is it calculated and what type of data influence the expected family contribution? What are the savings vehicles available to you? I'll get into the basic options with a heavy emphasis on 529 plans. So this chart takes a look at the cost of funding private college with a lump sum, with annual savings, and then strictly with cash flow. I think the lesson here, or the takeaway here, is save early. Now, these numbers can be somewhat staggering. So this is the cost of funding 4 years of private college for a newborn. So that price tag's $503,000. Now, if you were to make a lump sum investment, so if you have the resources and the cash flow to be able to do that in year one, the cost would be $176,000. Whereas if you're saving annually, the cost $276,000. So if we just simply evaluate annual savings, you're reducing your out-of-pocket costs by 45%. So if you are in the minority and you are fortunate to be able to cash flow the expense of college education, doesn't necessarily make the most financial sense. And the story here is leverage the power of compounding. It's a very, very powerful force, and it's something that you want to take advantage of. So, start early, save early, open some type of college savings plan. Essentially when your student is a newborn, if you have that opportunity, with niece, nephew, whoever it may be, because it's going to save you in the long run and save you substantially. Now, financial aid eligibility, this is where I reference the EFC, or the expected family contribution. So I'm not going to walk through all the calculations here, but these slides would be available if you'd like to see a copy later. We're happy to send these to you. But here's what you need to know. The number one factor is the student income and the student assets. I think that's key and most critical to understand. The majority of students have negligible income and they don't have significant assets. The second factor is the parental income. That even has a bigger influence on grants and aids versus the parent assets. We'll show you a chart on the next page. And then the third item of note, grandparents are not a consideration. So if you do have significant wealth from grandparents, that will not be a negative in terms of the eligibility for any kind of federal aid. One point to make: if you do open a 529 plan, which we will touch on later, make sure that you as a parent or the grantor, so to speak, or a grandparent is the owner of the plan for the purpose of both flexibility, the ability to change a beneficiary later, and also for the purpose of financial aid. So a deeper dive into that EFC calculation. If your income exceeds $250,000, even if you don't have any assets of significance, you're going to be expected to pay about $60,000, and that number is here in the bottom left-hand corner. You'll see with the income running vertically and the assets running horizontally. So if you look at the bottom left-hand side, essentially $60,000 a year is the expected family contribution. So the reality is the children of most of our clients are in a situation where they're not going to receive federal aid. But what I would tell you is, I would fill out the FAFSA form in every instance, and FAFSA form is the document that you complete to be eligible for financial aid. You want to complete that FAFSA form because that is the document that schools utilize to determine, any kind of assistance they're going to provide. And schools are often much more aggressive about providing a combination of merit-based aid and financial assistance, so they're going to want to see that FAFSA form completed because it's the most efficient way for them to receive the data. So the takeaway here is that if you have a healthy income, you have significant assets, just don't bypass the FAFSA form because there may be opportunities, particularly when you're assessing, private colleges. They may very well put together a fairly aggressive package to get that total cost of attendance down. So never rule a school out based off the listed tuition price. Federal student aid loan programs. We talked about loans as an option here, and what I would tell you is parents, plan to co-sign if you are going to make your child take out loans, and understand that the student debt ultimately will become your debt if it's not paid. The federal direct subsidized loans are fairly modest in terms of the amounts that can be borrowed, $3,500 to $5,500 per year. There's unsubsidized loans, and then anything exceeding the combination of those two figures are going to have to be private loans, and the interest rates are going to be significantly higher. So you can see the current rate for the subsidized Stafford loans are 5%. Once you get into the private space, now it's a function of, assets, net worth, cash flow, income, etc. So just understand the rules related to lending. So what are the options for saving? So now that we let's say we have positive cash flow, we have assets that we're able to put away, we want to assess the options that are available to you. I'll first start with the Coverdale on the right. This is the least commonly utilized. 5% of parents own Coverdale accounts. A couple issues with these kinds of accounts. Number one, there's income limitations on eligibility to contribute and low annual funding limits. You're only able to contribute $2,000 annually, so doesn't necessarily make that type of account particularly attractive to most. The custodial account, the option you see in the middle, this account gives you the greatest level of flexibility in terms of the use of the fund. So if your child happens to receive a full scholarship, doesn't need to use the funds for educational expenses, there's the flexibility. Custodial accounts can be used for any purpose, so a home purchase, whatever it may be, help starting a business, etc. The downside in the mind of most parents are that the custodial account is an irrevocable gift. So the flexibility can be a negative in terms of it's an irrevocable gift, so the child has full right to the assets at either age 18 or 21, depending upon the state of residence. So it's just important to understand that if you open this type of account and fund it. 529 college savings plan. I'm going to get into the details here in a moment, but this is the most popular vehicle for saving. It's the one that we tend to recommend most frequently, and I would say is the most appropriate solution for the majority of clients. There's also educational trust that can be established. I'm not going to get into that in any level of detail here today, but I do want to take a few moments to go into some depth on 529 plans. Several great benefits. Tax-deferred growth is probably the number one perk of a 529 plan. You don't pay taxes on any gains, similar to an IRA. And think of this as almost a Roth IRA for education. The distributions, provided they're qualified, are tax-free for education expenses. Now, not only is this tuition, room and board, it can include the purchase of a computer, and there are a variety of other miscellaneous expenses that would qualify. 529 offers the flexibility to change beneficiaries at any time. So if you have multiple children, one receives a full ride scholarship, you can actually change the ownership of that 529 to a sibling. You can also pass on to the next generation. So a grandchild could become the beneficiary of a 529 plan. You do have to be concerned about generation skipping taxes if you pass more than one generation. There are no gross income limitations on funding a 529 plan, and then there are some options for accelerated funding. You do need to be aware of the annual gifting rules, which we'll get into on the next page. So as it relates to gifting, 529 plans do offer the option of accelerated funding. Now, today's current annual gift limit is $15,000. You can give $15,000 to anyone you like without any estate tax or income tax implications. If you're married, between you and your spouse, you can gift $30,000. Now, what the 529 allows you to do is accelerate the funding and essentially perform 5-year averaging, so that you lump sum instead of $15,000, you could actually gift $75,000 per child per individual. So a married couple could gift $150,000. Now, you would not be able to make any further gifts over the course of the next 5 years without impacting your estate tax exemption. However, the accelerated funding is a great way to get a head start on college funding, providing you have the cash flow to do it. And if you remember the slide that I shared a few minutes ago, early funding reduces the overall cost because of the power of compounding that works for you. So it's another consideration that if you do have the assets and the cash flow to fund college, the 5-year accelerated funding can be very attractive. Common planning mistakes. Number one is waiting to save. The key is just open some kind of savings plan. Again, 529 is appropriate for most, and just start funding. It's the inertia that most people have is natural. Once you open the account, you can share deposit instructions with family members. Generally speaking, most relatives are more than happy to contribute to college funding and get everyone contributing early. Another common mistake, as I referenced earlier, ruling out schools based off the listed cost to attend. These colleges and universities know they're in competition for the best and the brightest students. So those who are gifted, who have strong GPAs or strong test scores, many universities are going to be more aggressive than you may anticipate to get that cost down. I would encourage you to take as many visits as possible and understand that listed cost to attend can be very, very negotiable. Another common mistake, failing to complete the FAFSA form, just assuming that you're not going to be eligible for any kind of aid or assistance. Again, these schools and the universities tend to be more aggressive, but they are going to reference that FAFSA form more often than not when they're assessing any kind of support. And then another mistake is giving cash directly to the student. So I talked about the annual gifting exclusion a few minutes ago, and there's also a lifetime estate tax exclusion that you want to consider. Essentially, any gifts in excess of the annual limit will reduce your lifetime estate tax exclusion. So one way to avoid that, if you wanted to provide more significant support to a student but didn't necessarily intend to fund a 529 plan, you can pay tuition to the college or university directly, and that is not subject to the annual gift tax limitations. So hypothetically, let's say tuition's $40,000 at a school, you could pay that $40,000 tuition directly as opposed to giving it to the student where you're subject to $15,000 per year, or if you're married, $30,000 between you and your spouse. So these small techniques can make a significant difference in planning and taking action. So what is it that you should do, or what are some things that you should know, as it relates to college planning? Action steps. Open a 529 plan as soon as you have a tax ID for the beneficiary. As I referenced a few minutes ago, make it easy for family members to help. Anyone can fund. So if you are a parent opening a 529 plan for your child, uncles, aunts, grandparents can all fund that same account. You don't have to open multiple accounts, for a beneficiary. More often than not, there's not a reason to do so. There are potential state tax deductions, which are beyond the scope of this on this podcast. But bring that up with your financial advisor. Feel free to give us a call for details on that topic. Begin applying to schools the start of the senior year in high school. So if you have an older student and you're coming down the home stretch, most application deadlines for colleges are in January. Well, at least that's when the deadlines start. Now, there is the ability to apply later, but essentially you want your applications in before the end of the calendar year. So make sure you get on that quickly. Most schools have allocated all of their merit-based aid and financial aid before the end of the year, so you want to be first in line for those offers, and then complete the FAFSA form as soon as October 1st of the year before the student will be attending college. So applying for family aid, this is just and again, federal student aid, and I would use these deadlines also when considering any kind of merit-based aid. Here are the deadlines for FAFSA. If a student's starting in college in 2020, basically what you're going to need to provide is, they're looking at your income tax year for 2018. So essentially, it's a 1-year look back. This is for the school year 2021, in other words, the college school year. So you're filing. So if you have a senior, you're filing your FAFSA in October of 2019 for the school year 2021. They're looking at your assets and your income tax for the calendar year 2018, if that makes sense. So don't delay. Get on board with completing your documents. Get ahead of the game. Open accounts. Start funding as soon as possible. And if you have more detailed questions, please reach out to your OJM advisor. We're happy to go into greater depth as it relates to college planning and address some of the topics that may be beyond the scope of this webinar. So thank you for tuning in.
OJM is a multidisciplinary wealth management firm, and we work with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.